Good day, everyone, and thank you for joining us. My name is Franita Newell, and I am the moderator for today's webinar. So before I introduce our speakers, there are a few housekeeping points I'd like to cover. At the bottom of the webinar screen, you should see a toolbar. You can use this toolbar to access a range of applications, such as our speaker biographies, webinar materials, and technical support. Click on the application and it should open on your screen. All applicants are resizable and movable, so feel free to move them around to get the most out of your screen space. Please submit your questions throughout the webinar via the Q&A box, and we'll try to answer.
Sorry, did we lose Pranita? Looks like we have. Okay, let's see if she comes back online. Hopefully you guys can hear me. I'll take over Pranita's role. Yes, there are questions that you can ask us as we proceed with the webinar. Feel free to post them as we go along. There's three speakers here today. Pranita, of course, she heads our is a performance director. She's focused on EMEA, and many of you may actually know her. Tim Gomer is going to do most of the talking here, and the demo. He's our director of fundamental research. He does a lot of work on the quantitative side, on star mine models and so on, so you'll hear from him. I am Mahesh Narayan. I look after the research and portfolio management proposition itself in terms of what we build, what we offer to our research analyst and PM community. And look, we will keep this as a interactive Q&A chat between myself and Tim as Tim walks us through some of his ideas, right? So what we would like to start off with is a quick poll, all right? I see a number of attendees here. Just to understand what type of company you work for. And look, we have at least one other poll, so let's also use this to make sure that the polling process works. I'll give you a minute. All right, as of now, look, a lot of asset managers, asset owners, which is great. We have a few corporates and banks and a number of others too, right? So fantastic. There's a lot of interesting stuff we will be discussing. One more poll before we get into the meat of the content, right? This webinar is about using quantitative techniques for your investment process, right? And people use it in very different manners. So a very simple question, are you using any quantitative techniques today as part of your process, right? It may be for idea generation, it may be for risk monitoring, it may be for any other purpose, right? So just give us a sense, are you using something on a consistent basis? Are you using something but on a limited basis, or are you purely fundamental with no quantitative aspect to your investment process? Sorry, we flip back to the prior one, but let me take it back here. All right, let's see. Good mix here, right? There's a good mix of people on a consistent basis, people who are using it on a limited basis, and then some who are still exploring it, right? So fantastic, that's very helpful. Let's move on to the meat of the discussion here, right? which is the webinar, the content. So, Tim, hope you're online. I'll give you control of the slides. Give us an introduction to what you plan to talk to, and then we can do Q&A as we go along.
Okay, happy to do that. Nice to see you again, Mahesh. So I'm encouraged to see that so many of our audience, uses some quantitative techniques, at least, to some limited extent. That's going to be the basis for our talk here today, is how to apply an overlay of quantitative research, in the search for, overlooked companies, things that may still be bargains out there. I'll say this is a challenging topic. We chose the title, a month or 6 weeks ago, back in the depths of a bear market. Turns out this is probably the shortest bear market we've ever experienced. So there's not nearly as many bargains out there as there once were. So we're going to be a little creative with the topic today and show you, where to search based on where we are in the current market environment. Let me show you why this may be a challenge. Normally you'd think we'd just turn immediately to, our valuation models. So StarMine has a number of valuation models. Let's see if I get my slide here. But here's the challenge. Do you see the data stream chart there, Mahesh?
Yep, we can see it. Yeah, so help us understand this, Tim. Yep.
Great. So this is from Refinitive's data stream product. So a macroeconomic charting tool, millions of data items, time series, content. So here I'm plotting the Russell 1000 growth index minus the value index. Right? So where the area that's shaded is above the zero axis, those are periods in which growth exceeded the value index performance results. So look at where we are today. Unprecedented levels historically, going back to 1990 here. I'm looking at the Russell 1000 because that incorporates the dot-com boom, so the tech bull market of 2000. We exceeded that level long ago. Right? So growth is greatly outperforming value. If you're going to just focus on value models exclusively, unless you have a benchmark that's just tied to value, you're going to be underperforming the market. Right? So that's why I say we need to be a little more creative in how we approach that. And it's not just a US only issue. Here's the MSCI Global. Right? So again, at unprecedented highs in the amount by which the valuation indices have underperformed the growth indices.
Tim,
so I thought
Tim,
we'd choose
this is really interesting, but now, which makes the idea of using some valuation within this growth outperformance even more useful, right? And that's what we'll be talking about in the webinar. So it's not just about picking value stocks, but it's about figuring out valuation as a metric, among other things, in terms of quantitative models, even in this growth phenomenon, right?
Absolutely. So yeah, we're going to look for overlooked or undervalued companies, but within a framework of what is currently working in the market. And let's take a look at what's working. Right, so here I'm looking at our most recent StarMine monthly performance report. By the way, you can subscribe to this. We put it out every month. As the name implies, it's available at lipperalphainsight.com, and you can subscribe to this. So here's what's been working well in developed Europe during the month of July. So we're looking at information coefficients here. That's a little geeky. What it is a correlation between these various factors and how well they explain stock price performance. So how is the correlation between a factor and returns? So in Europe, the best performing factor in July was trailing 12-month returns, a simple measure of momentum.
Momentum, yeah.
Then we have our StarMine. We have StarMine price momentum, or price mo. And so it's been a very momentum-driven month. Then we have the StarMine Analyst revisions model that looks at changes of sell-side estimates across an income statement over multiple periods of time. We have a combo model that combines all of our alpha models. Smart Holdings is looking at the buying behavior of institutional investors globally. And we aggregate those to see, okay, among the most recent reports from things like, 13Fs, based on their regulatory disclosures, what are institutional investors seeking out in terms of the characteristics of companies they seem to be buying? Are they buying growth stocks, value stocks, companies with lots of profits? Are they shunning companies with lots of leverage? All those things are true. And then we look at earnings quality, or EQ. So you can see what's not worked down here in the bottom during July. It's dividend yield, relative valuation, and intrinsic valuation.
So Tim, these factor models, like you said, are available for our clients, and you can get them on a monthly basis to understand what's working, what's not, right? This itself is a helpful tool, quantitative tool that you can use.
Yeah, that's the point. I'll show you someplace else you can find that. Are you able to see my desktop?
No, I think we're still seeing the StarMine performance report.
In the audience view, we can see the desktop.
Oh, okay, great. Okay, good.
Okay, good. So you can also find this. This is a live view with an icon. This is another place you can check out performance. You can do it by region for 1 month or 12 months. You can look at just large cap, mid cap, small cap, or all of them. So here I'm looking across developed Europe, the largest 2,000 companies. And you can see here in the bar chart for the 1 month ended July. These are top-bottom decile spreads. So as our models rank it and score companies on a 1 to 100 basis, where 100 is the most bullish, how is that top 10% doing versus that bottom 10%? What's the difference between the two during the month? You can see here, Analyst revisions was the best performing, up 9.5% just in that 1 month period. Here's the price momentum, a couple of percent. And then Smart Holdings, that institutional buying model, which is probably our most adaptive one, because as the preferences of the 25 characteristics that we look at, the institutional investors might seek out, we're essentially reverse engineering their new idea generation screen. It will change as their preferences change. Again, valuation had a down month. If you're long only, you can just look here at the top decile. So you get to this page by just typing StarMine into the search bar. And if you want any definitions on our models, we have all of those here too. So you can find a better explanation and sometimes little videos that explain each of the StarMine quantitative models. StarMine being the brand name that we apply to all of Refinitiv's more advanced alpha generating quantitative models.
I love this page, Tim. Look, I mean, this is a great way to get a quick understanding of what's working by region, by market cap, by period. Fantastic.
Great. So I thought we'd start by building our own custom quantitative model, a multi-factor approach to looking at these things that are working right now. Now, it's always a little dangerous. We don't want to just chase returns or chase factor performance. We could be a bit contrarian here, but that's not what I'm going to do today. It does worry me a little bit when I look at those data stream charts and you see, a very prolonged period of growth outperforming valuation up on a huge spike. I do believe in reversion to the mean. You find it throughout the academic literature. So we could reverse here, but you never know when that's going to happen. You can't predict it in advance. Let's focus for what we might look at in terms of doing additional research on overlooked companies, things that are perhaps bargains today, on what's working right now. So there's several ways we could do that. But the approach I'm going to take is to look at one of our quantitative tools. Let me see if I can.
And Tim, what you're going to bring up is going to answer one of the questions that's already been posed. Is it possible to look at the Starman results by gig sectors instead of, the region and the market cap? But keep going.
Yeah, we can certainly do that. And you'll find that there are some sector biases right now. So if you look at just a generic value index, you'll find overweight financial sector and energy companies. This is why we don't want to just follow it blindly. The growth indices are dominated by tech stocks right now. So probably no great surprise. So can you see QA Point?
Yes, we do. Yep.
Terrific. So QA Point is a point-and-click backtesting tool. It's powered by our partner Elson. I'm just in a browser here. So this is completely web-based, service, software as a service. So I'm using here as my universe, the stock 600. I can go in here and create a factor model. So you see this is very quick. So I've partially built a model here. So I put in earnings quality. We saw that's working well in July. Analyst revisions model, the best performing model in Europe right now. That's smart holdings. All these are regional ranks, 1 to 100. Because growth is outperforming value, I want to put a measure of growth here. So here I'm turning to the IBIS long-term growth estimate, LTG. And I'm looking at sales growth or revenue growth. So I want companies that are benefiting from top-line growth and not just cost-cutting. I'm going to add another factor. But before I do that, let's see how well this multi-factor model would work. See how easy it is to backtest? I don't have to write any code. So for this demo, here's our 4-factor model. Generated annualized returns year-to-date, 32%, with a really nice Sharpe ratio, so good risk-adjusted returns at 2.4. See the top decile is down 10%. The bottom one's down 26%. So that's where this is really saving you, is as a risk mitigation tool, that worst performing group versus the benchmark. But that's cap weighted. The better measure is the equal weighted universe, which is down 13.4%. So our top decile is outperforming the overall universe. The bottom decile is greatly underperforming. I'm going to add in one more factor just to show you how easy this is. So remember momentum. Momentum's been one of the best performing factors. So I'm going to add a factor. And we've got Starmine as its own category. Oops.
And Tim, we can use QA Point here to really do this analysis for any subset of a universe, if you'd like, right? We could even pick a industry. You could pick a region. You could, right? It's the universe is literally up to us to pick and then do the analysis.
That's right. That first page I started on showed the stock 600, but I could put in any other index, or I could even put in my own custom universe if you've predefined your investable universe. So here I have the price momentum region rank, and then I'll just edit a few options here. I don't want to fill with a median. If it's not there, just ignore it. Everything will have a momentum score. It's already 1 to 100. I can just use the raw scores. I'll save that. So I'm updating my model. Now we have a multi-factor model based on what's performing well right now. And let's go test this new iteration. Let's test it year to date. So since January 1st, I am taxing the limits of my home bandwidth.
But it's still remarkably fast, especially given the amount of hit it's doing the analysis on, right? There it is.
That's right. So we've done all this back testing across multiple factors, almost real time. Look how much better the returns are now that we've thrown momentum into the mix. Almost 58% annualized returns. Boy, wouldn't we like that? So now the top decile is down 3.7%. The bottom's down 29%. So this really saves you. It's like not just alpha in the stocks that you pick, but generating alpha in the losers you avoid, compared to the equal weighted universe here of down 13.4%. So, exactly what we'd like to see. And I can click this and see the actual companies. But I thought we could replicate this now that we've confirmed that it works really, really well so far this year by generating a screen and icon and looking at individual companies that this multi-factor model would spit out.
Great. Look, Tim, let me just make sure people are understand sort of the sequence of things here. So you could use StarMind factor models to understand what's working, what's not in the framework. If you want, you could use QA Point to create your own custom factors to figure out what's working, what's not, right? And now we're saying, okay, now that we understand what's working, what's not, let's actually use the screener to identify some names, right? That we can sort of do.
Thank you, Mahesh. Yeah, that's exactly it. It's a great summary. So here I am in the icon screener. So I thought we'd filter out a couple of things. So let's throw out the lowest quality companies. So I just need greater than the bottom quartile, 25. To make sure the companies don't have really challenged balance sheets right now, we can use our credit risk models to get rid of the bottom 25% that might have a lot of leverage, poor interest coverage, no cash on the balance sheet, those sort of risky things. Let's make sure companies are sustainable, not just in the short term, but over the long term as well. So I'm using our ESG scores, environmental, social, and governance, of course, getting rid of those in the bottom half. And then I'm looking at price to earnings of less than or equal to 20. So this is where we throw bargains into the mix. I don't need to have it dirt cheap, but let's look at PE ratios of under 20. And then I'm using our multi-factor ranking feature. So I don't just go add filter after filter. Pretty soon I'll be down, instead of 118 companies, I'll be down to 5. So instead, I'm creating our own quantitative model here. So I'll show you what I put together for this demo. So our bargains webinar. So again, same four things we just tested in our back tester in QA point. So looking at price momentum, analyst revisions, smart holdings, earnings quality, and looking at revenue growth. Here I'm using the Starmine growth rate this year versus last year. Equal weighting them all. So it's easy, you just create a new factor rank. You can add another factor to this. So this is going to create its own 1 to 100 percentile rank based on an equal weighted combination of those 5 factors. And here we go from top to bottom. So Valmet's at the top in our earnings quality measure, the sustainability of a company's earnings. It's an enhancement of the accruals anomaly, if that means something. It's a perfect 100, top 1% of all companies across Europe, a fairly moderate PE ratio of under 17. You can see here, it's not up a lot this year, 9%. It's showing good top line growth, 12%. Bottom line growth, almost 11%. Looking forward, our projection of a 5-year compound annual growth rate of 5%, and it gets a good ESG score. So we can drill down that. Whereas things like Sentimine, Sentiment, it's number 2, but it's up 60% this year, as is Polymetal. It's good to be in gold and silver mining this year. Maybe we missed it, up 64%. So we can take a look at that. Looking down just a little bit more, I see Roche. It also has a really high quality score. Gets an A on a combined credit risk model. But we can drill down on any of these.
And now you're getting into the fundamental analysis, right, Tim? Once you've sort of identified anything that you want to, anything that's screened into your name, into your multi-factor model.
That's right. I think maybe the best approach is, not to focus exclusively on relying only on quantitative modeling or only on fundamental analysis, but to put the best of both worlds together. The computer can sift through, thousands of companies and refresh it every day, but there's some things human analysts, know that the computers still can't figure out. So this is a company that provides equipment and services for paper and pulp services. So, things like tissue paper, right? So a company exposed to toilet paper and paper towels, not necessarily a bad place to be this year. If you look over here, we have all of our Starmine models. We sort them into bullish and bearish categories. They're all bullish. There's no bearish here. We can drill down on any of these. Putting a fundamental overlay, on top of our quantitative analysis. So again, a 100 on a 1 to a 100 score. Over here, you can see the history. We put green boxes around bullish signals, red boxes around negative contributors. Consistently a high quality company here. You can look at the history over time, and we can drill down on any of these. So where it's green, it shows what's contributing to that 100 score. If there's a red, like CapEx, that's what's detracting. We can look at time series analysis. So let's look at cash flow. Companies that generate a lot of free cash in this market can probably sustain a dividend or won't have to tap the capital markets to cover operating expenses. It's a good thing when, capital markets may be a bit challenged. I can look at it quarterly, I can look at it annually. So the green portion of the bars show the amount by which free cash flow exceeds reported net income, the portion in white. If cash flow lags reported net income, like it did back here in 2015, we show that deficit in red. So you can see that Valmet's kicking off lots of free cash flow, so cash left over even after covering capital expenditures. I thought we'd take a look at one more for those who really want bargains here, and that's why you joined. Let's try to find kind of a deep value stock. And I was kind of drawn to this one, Signify. Because on this list, we moved down here a little bit. Now we're in the 777 lab. But look, it's got a PE of 9.56. So one of the lowest PEs on this entire list. Still, it's only up 2.6% year to date. It's showing top line growth, great bottom line growth. It gets an A on our ESG scores, expected to grow over the next 5 years at a compounded rate of 6.5%. Not too bad, but Signify. Again, looking at our overview page, where we summarize a lot of information in just one place. It'll pop up here in a second. You'll see that this is the former lighting business of Philips. So traditional light bulbs, new LED lighting, a number of other things. We can look at its models too. Here, Analyst revisions is 88. So our Analyst revisions model is not just looking at change in the consensus number over, say, the current quarter. This quarter, the 4-year, next year, we're looking across the income statement, so EPS, EBITDA, and revenue. We have a StarMine Smart estimate that instead of just equal weighting every sell-side analyst out there, regardless of the skill of the analyst or the age of the estimate, we're placing more weight on the more accurate analysts and the more recent estimates. When that's different than consensus, we call that percentage difference the predicted surprise. It's predictive of the direction of future revisions and future earnings surprises. So it gets the direction of earnings surprises correct 70% of the time. Our most recent forecast, and we put out one every year for Europe, got 10 out of 10 correct, so 100% directionally correct. So it's a reinforcing signal here. You can see it in each of these time periods. So we would expect further upward revisions with Signify. And if we look at how it's done in the most recent earnings season, you can see there's been a nice positive upward surprise. It'll load here in just a second. Again, my home bandwidth is being stretched to the limits. So here's the March results. So the Smart estimate, here's the more recent one. Smart estimate was 40 cents, which is above the consensus of 38 euros, 0.38. It came in at 0.72, right? A 90% upside surprise. So things seem to be going well for this company. Again, if we look at the financial fundamentals, looking at earnings quality, you can see it's been a high quality company. They've done a recent acquisition that's thrown off the accruals a bit, but if we look at cash flows, again, we'll look at free cash flows for the full year period. Again, a huge free cash flow generator. Look at the amount by which free cash flow exceeds net income, 541 million euros for 2019 versus reported net income of 262 million. So apparently very conservative accounting, huge free cash flow generating, showing top and bottom line growth, and trading at a PE of under 10. So, maybe worth, looking into a little further. I don't know the company beyond.
Tim, two great examples. Two great examples you pulled out using the process of either using StarMine scores to understand what's working, or using a backtesting tool and then bringing it into Screener, right? One question that I see on the list is our credit ranking model. Does it use what does it use besides ratings agencies' credit?
So we don't use credit rating agencies' data at all. In fact, our model attempts to be more predictive of what agencies will do in the future. And we can generate credit risk model scores on companies that have no agency coverage whatsoever. It's been picking up a lot of the recent problems out there in the market. That we are way ahead of last year in terms of bankruptcies, especially in the energy sector, companies in hospitality, companies like Hertz. Not great when all of your assets are parked at airports, when people don't go to airports anymore. So not only do we have alpha models, but we've got these risk models.
Got it. So we are using fundamental data to have a forward-looking view on credit risk instead of we're not just relying on the agency ratings. Yeah.
Not at all. We'll display the rating if they have one, but we generate a probability of default, which we then map to what the agencies would do with a similar level of default. So they're very transparent about that these days. So we can say, given this probability of default, what letter rating would an agency apply? So we attempt to do something similar in a quantitative way. So we look at credit risk three ways. We have a structural model that looks at the market value of assets to liabilities as a measure of leverage. We use a number of fundamental financial ratios, both backward-looking and forward estimates data. And then we have a patented text mining model that looks at the unstructured text in transcripts, news, filings, and research to find keywords and phrases that are predictive of default. And here you can see that our model in blue, that implied rating was well below the actual rating agency for quite a period of time here. So it gave you a big heads up. So not only is this great in terms of a bargain hunt, but also avoiding risk, which can be another source of alpha.
Perfect. So look, I mean, lots of tools, lots of data to help the investment teams use some quantitative framework to identify either companies or industries that may be of interest for them. Is there anything else you want to share, Tim, before we take some more questions?
Yeah, I think there's one final thing I wanted to share, and that's kind of, let's take a look at the earnings season. How is it going so far? So we have an earnings season application within Icon. To get to this, just type EARN, E-A-R-N, into the search bar. And you can pick your universe. Here I pick the stock 600. I can put in my own custom one. I can put in Russell 3000, S&P 500, my own holdings. So looking at the stock 600, staying with the theme here, I can sort by market cap, or here I'm looking at sector. So somebody asked about, can we see what's going on at the GICS sector level? Yeah, we can use that, or we can use the TRBC indices. So we're mostly through earnings season. 84% of all companies have already reported within this index. 60% have beat, 6% have met, and 34% have missed. As we look at it by sector, where are the leaders and laggards? Here, tech, 73% beat. Materials is doing well at 70%. Pretty good during an industrial slowdown. If we look at the laggards, real estate, only 36% of the companies reported. There's 16 of them in the index have beaten. 57% have missed. Utilities not doing too well either. Energy sector, well below half. And then if we kind of look left to right, we can look at companies' surprises. Those have reported. How are they doing? So you can see industrials have had the biggest positive surprise. Information technology, tech, those are reported. The average surprise has been 13% to the upside. Of those yet to report, we look at the Starmine predicted surprise percent, because it's very predictive of the direction of future surprises. So healthcare, consumer discretionary, consumer staples are looking good. Here, industrials, oddly in contrast to the reported actual. I put in the analyst earnings revisions model, again, predictive of the direction of surprises and revisions. Of those companies yet to report, we can look at, again, the implied growth rates. Looking at next quarter revisions can be a proxy for the kind of guidance companies are giving when they report, or what analysts are inferring from their report. And you can see that those who have reported, analysts have actually reduced their estimates in tech, materials, industrials, those with the biggest upside surprises. Maybe it's been a bit overdone. They're revising up financials, consumer discretionary, consumer staples, and communication services. They think the consumer is still out there spending. Of those companies that have yet to report, they've been much more pessimistic in like the financial sector. And then we look at how the market reacts. So in the 2 days following a company's report, those that beat, in tech, they were up 3.2%. Those that missed, down 2.9%. That's kind of what you'd expect. A little different with industrials, regardless of whether they beat or missed, the market, priced them all higher. And we also look at how companies have done over the last 4 weeks before reporting. So the earnings season app is useful for, tracking whatever universe you're interested in as the earnings season actually unfolds. So that was the last thing I planned to share, Mahesh. I'm happy to take some questions.
Great. Look, while we look through the list of questions, what's interesting about the earnings app is it gives you a snapshot view of how a specific company or industry performed this quarter, all right, the prior quarter. And I would think if you're a quant-focused investor, you would probably want to combine the StarMine models, the back testing strategy, and the earnings app in some way to identify some ideas, right? I think it's a great combination of tools. And no one process is applicable to every investor. We all have different styles of investing. Great to hear.
Yeah, I just shared sort of my approach to doing research when, trying to figure out what next story to put on our blog post or something that might look interesting. Of course, there's a lot of ways to go at that. But, the approach I showed today is let's figure out what's working today. Let's take that information and look at companies that may be, fitting the current set of market preferences. And then doing some deep fundamental research on top of that.
So we have one question, a couple of questions around how does anyone get access to QA Point? I would say just speak to your salesperson, and they'll be able to let you know how that's done. It's a commercially available product. We have a number of clients who already use it.
Just on that, we'll also have a survey at the end. It will pop up, and you will be able to actually say that you're interested in getting access to QA Points as a trial during that survey, so we can contact you. And we also have a link to QA Points in the resources tab, or the resources application that you can access and fill in your details there if you're interested in finding out more about that product or anything else that we've mentioned, such as StarMine as well.
Great. Any other questions, Pranita, from your side to Tim?
Yeah, I guess just one thing from our side. I mean, we cover the entire EMEA on this call, and we sent invites to our EMEA database, essentially. Tim, do you want to go maybe through the benefits of, being able to look at star mine ratings? I think we touched on it briefly earlier where we spoke about, credit rating agencies and how those compare to the star mine ratings. But I think what's quite important is to note that we can have a star mine rating on a company that doesn't necessarily have a credit rating with another credit rating agency. And that's one of the benefits. So do you just want to elaborate a little bit more on that?
Yeah, so we can generate scores on any company that's trading. For our structural credit risk model, we just need the current price to back into the market value of assets. We need a balance sheet to look at liabilities. All publicly traded companies and actually a lot of private companies have that information out there. So with our ratios approach, looking at financial ratios, we also score hundreds of thousands of private companies, as well as all the public ones. We've got something like, 40,000 public companies that we generate ratings on. So in terms of risk mitigation, avoiding those companies that may have to do a really expensive emergency fundraising, tapping the capital markets at junk bond levels, a rights offering, or at risk of bankruptcy. It's great to have that quantitative overlay that updates every single day. So it's a way to avoid risk. But on the alpha side, there were, mostly building on established academic research. In most markets, valuation works. So you look at our valuation models. Momentum, is a well-established concept, and you can see that's very popular in the market right now. Earnings quality, that builds on research originally out of the University of Michigan with Richard Sloan and his associates and what became known as the accruals anomaly. So a lot of our work is an enhancement on established sort of market anomalies that's well documented in the academic research, and we enhance that, make it work better. But when we build a few of our own, like that smart holdings model that looks at institutional buying preferences. So it's a lot of things that if you had all day, you could drill down into a single company and look at all those different elements. But what's nice about this is we can systematically point you in the right directions, hopefully, across a huge universe, updated every day.
Tim, we have another question that came through asking if there is a way that we can compare the performance of the rating agency ratings versus the star mine credit ratings.
No, we don't have that comparison, and we don't have access to all the rating agencies, or how would you measure that performance? I mean, we've been catching a lot of bankruptcies before they happen, and blogging about those. But the way we look at performance within credit models is a little different than for our alpha models, where you look at like top-bottom decile spreads or Sharpe ratios or information coefficients. Our credit risk models aren't an alpha model. I wouldn't recommend putting it into your own multi-factor model, which you see I filtered on it to get rid of those at the start of, defining my universe within the stock 600 before I applied my alpha model. You put it into the mix and you're combining something that's not really an alpha model with your other alpha signals. So I'd use it to filter out the riskiest companies first, as we did. So we look at accuracy ratios to define the performance of credit risk models. So if we look at how many default events, which is our definition of what we were modeling against, and a default event includes bankruptcy, of course. How many defaults did we catch within, say, the bottom 20% of our universe ranks, compared to, say, a basic model based on academic research, or something like the Altman Z-score, which has been used since the 60s. And we outperformed all of those, otherwise we wouldn't have made it commercially available. We have white papers, all of our models, by the way.
Yep, that's right. So if you need more information about that as well, the white papers, you can request it through, obviously, saying that you're interested in StarMine or requesting it through from your sales team, and they'll be able to supply you with that. Thank you, Tim. Thank you, Mahesh. And apologies from my side for the break in transmission a little bit earlier on. Technical issues are now sorted. Anyways, I'd like to say thank you very much to everyone who made the effort to join this afternoon. It was great having you on the line. Thank you for the questions that came through. Just as a final reminder as well, please do complete the survey that will pop up at the end as we end this webinar, and you'll be able to request more information about what we spoke about today on that pop-up as well. So please do complete that. Right. With that, thank you a lot, Tim. Thank you, Mahesh, for your time and your insights today. It was great. And hopefully we'll speak again soon.
Great.
Thank you,
Thanks.
everyone.